Let's welcome on board Nikhil Ranka, CIO Equity Alternatives at Nuvama Asset Management, joining in on the show right now. Nikhil, hi, thanks for your time and good to have you on the show. Just wanted to understand what's the market construct looking like to you, while of course we've come out of the woods, or at least so it seems, in terms of how prices have been moving, but still got that 90-day headroom for the tariff negotiations. Which way do you think Indian markets are going to be headed?
So, good afternoon, Aisha, and thanks for having me on the show. So, post the 10% odd rallies that we have seen from the February lows, my sense is the easy money is now off the table, and we are probably looking at a single-digit upside from here on. So, if you look at the period from post-COVID 2021 to 2025. One of the reasons why markets had that 17-18% CAGR was that earnings growth were very strong. We had double-digit earnings growth all through. FY25 was the first year where we had single-digit earnings growth after some time. And if you look at the Nifty returns of FY25, we were at close to 5-6%. Now, as we move into FY26 and FY27, we have this uncertainty of tariffs hanging over. And we've continuously been seeing earnings cut happening. So we started 3 months back with FY27 EPS estimates at close to 1350. And now the consensus has moved down closer to 1310 levels. My sense is, given the uncertainty that is going around, we will have further cut to these numbers. And therefore, if I put a 20 times multiple, we are probably looking at somewhere close to 26,000 levels on the Nifty 12 months down the line. And from these levels, therefore, it means that we will probably have single-digit earnings upside on Nifty from here on.
Okay.
In terms of tariff, I think, 90-day period is more for negotiations that, countries which had put some sort of tariffs, it actually gets ratified and US gets to low tariffs when they are exporting to these countries. My base case is that eventually the 10% tariffs will stay and we will have nothing on the reciprocal tariffs from there on.
Right, so that's a take coming in on the markets as well as the entire tariff uncertainty. Hi, good afternoon, Nikhil. I wanted to get your view actually on the IT sector, given the fact that today it's having a good run on back of the fact that you have HCL Tech's guidance that has actually perked up the street. But what's your take on the IT space? How should one actually play this theme, given the fact there's a lot of gray area right now?
Compare this period, if you go back in history, and what we did was we compared how did FY21 pan out for most of IT companies because COVID happened in March 20. And we saw that, Q1 and Q2 of FY21 were the 2 quarters there was very high uncertainty. There were 2-3% QOQ sequential decline in revenues of most IT companies. But for the full year, if you look at it, third quarter and fourth quarter, they bounced back very strongly, and very few companies had full year revenue decline for that year. My sense is that situation this time is not as bad as it was during COVID, because at that point there was complete dislocation. And the initial commentary that we have heard from the likes of Infosys or HCL Tech, the managements have clearly called out that they are just seeing some delays, but there are no deal cancellations. So once this tariff uncertainty subsides, my sense is in the second half of the year, typically seasonally it's a weak quarter, but this time H2 could be a bit stronger because the budgets which have been delayed in the first half could come up for spending in second half. And therefore, overall, although this will be a single-digit revenue growth year, my sense is we should still be fine. And remember, balance sheet problems are much difficult to solve. In the case of IT, most of the companies are cash rich. And the demand problem is probably a 1 or 2 quarter problem. The moment we see that coming back, valuations will start getting re-rated again. Infosys, which used to trade at closer to 22-23 times, has today re-rated close to 18-19 times. And similarly, for a lot of IT names, we are probably today 1 standard deviation below mean from where we used to be, say, 6 to 9 months back. So as certainty starts to come in, my sense is valuations will again start inching up for IT names. on an absolute basis, the downside looks very, very limited, but there could be some time consolidation in these names.
Interesting you say that, Nikhil. But what's your view then on the overall sectoral composition that one should have in one's portfolio right now? And I'm going to keep banks out of this because I'm guessing much like the consensus view on the street, banks, of course, do make it to your outperform list. But other than that, where do you think signs of outperformance, underperformance are currently visible within the markets?
So I think metals and pharma should start coming back again. So metals, obviously, we've seen 12% safeguard duty coming through. So in that sense, that does provide a floor for most of the names in terms of pricing action. Even if internationally there is some pricing pressure on steel prices, given that one, raw material prices have come down, and second, there is that cushion of safeguard duties. I think there is a natural protection for most of the metal companies, and there is a dollar weakening trend also going out around the world. DXY used to trade at closer to 109 levels a month back. It is now closer to 100 levels. So typically in such a macro backdrop, metals tend to perform very well. And secondly, if you look at pharma also, given the uncertainty on tariffs, a lot of pharma names did underperform, but my sense is, given the fact that almost 50% of the generic requirements of US is being met by Indian companies, and the fact that margins are not very high in generics, it is unlikely that we will have significant tariffs coming on pharma companies. And once the uncertainty on that part settles, my sense is investor interest will start coming back on pharma names as well. So these are the two sectors I think that they start performing as some sort of visibility on tariff starts to come.
All right, so that's the take coming in on the pharma space as well as the metal space. But let's talk about the banking space, because you have Axis Bank that is now all set to report its Q4 numbers. Gaurav is here to tell us what the street is penciling in for Axis Bank. Gaurav, over to you.
Well, yes. When it comes to Axis Bank, we are expecting advances to grow somewhere in the range of 9%, while deposit growth could remain somewhere in the range of 7 to 8%. And as a result, when we talk about net interest income, it is likely to grow somewhere in the range of 6% on a year-on-year basis. When we talk about other income, usually Q4 is stronger for other income, but given that there are expectations that there may be some slowdown in loan book growth for Axis in Q4, we may see a lower fee income this quarter. And as a result, when we talk about PPOP, it is expected to grow somewhere in the range of 4 to 5%. When we talk about provisions now, there are no major concerns about the asset quality, but credit cost is likely to inch up to normalized level of 0.9%. And as a result, when we talk about profitability, now street is expecting profitability to decline almost by 4% on a year-on-year basis, although it may remain healthy with a growth of around 6% on a sequential basis. When it comes to net interest margins, now street is expecting some kind of softness in net interest margins because of the EBLR linked loans, and second is the change in loan book mix. So definitely a 3 basis point of fall is what they are expecting. But let's not forget that the peer banks have already reported some uptick in net interest margins, so definitely there is a scope of positive surprise here as well. In terms of the commentary, loan book growth and deposit growth commentary is definitely something to watch out for, and it is also very important to see how bank is commenting on the margin outlook for FY26. But definitely on the back of the numbers, we are expecting good set of numbers with some expectation of positive surprise from Axis Bank.
Okay, that's the take coming in on what to expect from Axis Bank right now in trade. But Nikhil, just wanted your pecking order within banks, and other than ICICI Bank and HDFC Bank, would you say look at some of the bottom-up stories, look at PSBs, or would you say stick by with the large private bank players?
So Asha, I would say on the private bank side, a lot of sort of multiples which had got compressed when the liquidity situation was bad, that has got normalized. So, 3 months back, if you see, the banking system was in a deficit of close to 3.5 lakh crores. But post the new RBI governor coming in, there's a complete change in stance. We've seen a lot of OMOs happening, and the system is back to neutral to surplus levels. And given that backdrop, a lot of the large cap private bank names have now sort of gone close to where they historically used to trade at. I think there could be some catching up that could happen on the PSU bank side. And my sense is on the MFI sector also, based on our interaction, we feel that this quarter could be the peak asset quality stress for MFI banks. And from here on, as we head into Q1 and Q2, things will start improving materially from these levels because typically by their nature, MFI are short tenure loans. And so whatever stress has to get accounted in 2 to 3 quarters, everything gets accounted. So post this quarter, I think there could be an interesting entry point for some of the MFI names as well. And investors could look at those names from a 9 to 12-month perspective.
Okay, that's the take on banks. But what about the rest of the market? We spoke with Harold Vanderlyn today from HSBC, and here's what he's making of the global setup and how India is positioned amidst that.
We've seen in India, of course, is that growth is actually slowing so far, actually, through the result season. It's so far the guidance has been a little bit better than I would have anticipated. But let's see what happens. But growth is slowing. But still, the feeling is that structurally, growth in India over the next couple of years should be okay. It's maybe earnings growth somewhere between the 10 to 15% or so. And in the current kind of global environment, that doesn't look too bad. What do we need to see really to get more positive? Now, we actually were quite cautious on India 12 months ago. Not so long ago, we said, listen, let's be neutral because we think that's a little bit more balanced because a lot of the things that we were worried about to a certain extent had already been priced in by the market or had faded. You have, for example, valuations lower. The realization that the earnings growth is not going to be as fantastic as it were over the last 3 years is now well priced into the market. Also that you have some policy support that can come through that can be good for the market. So in that sense, India starts to look a little bit better from here on. The sectors that we talk about with foreign, mostly for investors, is to a large extent large liquid sectors where valuations are reasonable. So you end up with the banks very often, private banks in particular, or where valuations are maybe a little bit more elevated, but where at least the growth story is relatively macro insensitive in the sense that, for example, is dependent on demographic or slow shifts in society that even though interest rates go up or down, don't really change that much. Think about, for example, rising consumption or, for example, demand for medical and healthcare in India, such as hospitals and these sort of things. So those are the sectors where we look at as well. So bank, consumer, and I would say selected but domestic healthcare.
All right, let's talk about the banking space, given the fact that this one has seen a lot of action, especially on the regulatory front as well. And you've seen a lot of respite coming in for the space. You had HDFC Bank, you had ICICI Bank report good set of numbers, and post that also you saw an up move in some of these counters. We spoke to Rahul Jain, who is the head of APAC Financials and India Equity Research at Goldman Sachs this morning. And he said that they're expecting the credit cost to peak out in the next 2 quarters. Hear out his views.
As we start to look out into this financial year, we feel that the sector actually will start having better visibility on its profitability over the next couple of quarters. This will be on the back of 2 important variables. One is the credit cost. So for the last 2 years, we've been quite cautious on the unsecured lending across different segments. We clearly see that starting to peak in terms of the a pain point for the banking sector. And that will mean that over the next 1 or 2 quarters, the credit cost will start to peak out for the sector. And also on the margins front, given that the Reserve Bank of India started cutting the repo rate, we feel that most of the impact on the margin should be reflected in by the second quarter. So by second quarter, we expect the EPS cuts to start bottoming out. And there, getting to your point about the start of the earnings season has been rather good. The lenders have managed to maintain their profitability, and we've already seen the cut in savings rate, etc., which will also support the profitability. The impact of the NIMs would be well absorbed from the policy rates. From the investor standpoint, they clearly seem to prefer the entities that can produce predictable earnings quality and stable profitability profiles. So clearly, I think the private banks and NBFCs are being preferred by the investors that we are speaking to at this point of time.
Okay, that's largely the overall view on the markets right now. Lots of earnings that we're going to be tracking come today as well. But for the day, it's really technology, which is where you're seeing the big movers. Other than that, Nikhil, just wanted to understand whether there are any contra plays in the market right now. What I see is some of these globally linked auto ancillary sectors or stocks as well are moving out. You've got a Bharat Forge, a Tata Motors, Sona Comstar, which are seeing some decent traction today. Anything that you would go by?
So we are a bit cautious on the auto space, Aisha, predominantly for two reasons. One is, if you look at it, there is a possibility that margins could come under some pressure. So if we have steel prices moving up because of the safeguard duties, given that the demand scenario is extremely weak, my sense is it will be difficult to pass on the entire cost push. And to that extent, there can be some pressure on margins in the near term. And the second is, if you look at the sort of inventory in the inventory in the channels is pretty high. And therefore, unless we see secondary sales picking up, incrementally to push primary sales will become extremely difficult. And therefore, when we see the volume numbers getting reported over the next few months, my sense is the street will start getting disappointed with that. And so on the auto side, predominantly, we feel that stocks can consolidate here for some time or can even move a bit lower from the current levels. On the auto anch side, I think, as the uncertainty on this tariff subsides, because a lot of them have global exposure, those stocks had come down quite a lot. And now with things stabilizing a bit, those stocks are doing some bit of catch up. But globally, if you look at the charts of any auto companies, be it Volkswagen, Daimler, Chrysler, everything has seen 30-40% decline over the last 12 to 15 months. So globally also, the auto industry is not in a very good shape. We saw the commentary from a lot of IT companies also, which are dependent on autos, that they are seeing some sort of demand slowdown over there also. So auto is not one of the sectors which is in our preferred list right now.
Coming on the auto space, but Kunal, I wanted to get your views and your actually BTST idea for our viewers.
So there'll be two buy calls. The first one which I would be suggesting would be a bond DMart. That's a stock which I think is now making a comeback. It's back again to that 4,500 plus levels. So I think looks attractive for 47.50 as a target. Stop loss could be kept at 43.50. And CDSL is the other stock which I would suggest, as a BTST play. The stock is heading towards a Bollinger Band breakout as well as a range breakout about 1350 plus mark. So 1500 as a target. Stop loss at 1300 for CDSL.
All right, so those are some of the BTST ideas coming in from Kunal, CDSL as well as DMart. You did speak about the auto space right now, actually, Nikhil, but I just wanted to get your view, especially on the auto anch space and a detailed one that I believe you spoke about that as well. You did touch upon auto anch as well, along with the auto space. But let me talk about the realty space then. How is that one looking to you, given the fact that, yes, let's look at domestic-oriented stocks or the sectors? That's the call coming in from most of the experts. What's your view on the realty space? And are you also in the camp that you should look at realty space right now?
If you typically look at it, whenever we have a very sharp dip in markets, real estate typically is at the receiving end because, real estate sector is something where, the wealth effect plays a lot in that sense. So typically when you are in the last stage of a bull market, those are the times when you see the peak of the real estate cycle in that sense. And in this time, last 6-7 months, given the sort of wealth destruction that had happened in the markets, real estate stocks had also seen 30-40% fall. But my sense is in terms of pre-sales, in terms of launch pipeline, most of the names are on track. And the second biggest advantage is this time around, if you look at the balance sheet of a lot of real estate stocks, the balance sheet is in very good health. Most of them have cash on balance sheet also. And for some of the names, like DLF, Prestige, Commercial now accounts substantial 30-40% of their overall SOTP in that sense. So given that backdrop, because that is a more defensive part of the segment, overall valuations would not compress that much. And after a 20-25% drop in most of the names. I think there's reasonable value that is there in most of the names from these levels. With a 12-month horizon, given the fact that we don't feel markets will go and retest back that 21,800, 22,000 levels, real estate should do okay from here on.
Coming in on realty right now. Today, of course, the big buzzers are really from within the IT pack. Metals as well is seeing some sporadic moves. And selectively, you're seeing pharma, led by Sun Pharma, also hold up quite smartly in trade. The underperformers today are oil and gas, cement, telecom, and some of the private banking, or rather, I should say, large cap names are the ones which are relatively quiet in today's trading session. Add to that some of those infra plays as well. Nikhil, what's your view on infra as a pack right now? They too have corrected quite a fair bit in the recent market fall, but anything that you think domestic linked could be interesting at this juncture?
So Aisha, what had happened was, if you look at the FY25 capex budget of government, that was close to 10 lakh crores. And if you look at the spending that had happened in the first 9 months, the spending in the first 9 months was very, very weak in that sense. And therefore, people got concerned about the order inflow numbers for a lot of these companies, as well as there was some delay in payments as well because of the populism of schemes that had come through. But as we have moved into Q4, we've seen a substantial pickup and spending that has happened from the government side. I mean, Q4 to Q4 YOY growth, if you look at in terms of capex spending, it's in excess of 60%. And because of that, I think the stocks will start to see revival once again. In the case of, probably Larsen, one of the apprehensions that the street will have is Larsen does have international exposure to Middle East. And with oil prices coming under pressure down to 62, 63, there could be some spending cut that could happen from these countries, and that could reflect in international order backlogs. Having said that, my sense is for FY26, the spending should be more even across the 4 quarters. It should not be very back-ended. And therefore, we should not have that concerns on the infra names going forward.
All right, so that's the take coming in on the infra space. On that note, thank you so much, Nikhil, as well as Kunal, for being part of the show and talking about the strategy that one can adopt actually in this market.